Hey, good morning, guys. So from the last video, I told us about the order block, which is always your last red candle before an impulsive sell caused a break of structure, or your last green candle. Sorry, your last red candle. Sorry, your last green candle, yes, before an impulsive sell, or your last sell candle, the last sell candle before an impulsive buy. So for this one now, you anticipate what was it called? First break of structure, second break, anticipate price going back to this zone to continue. That is skeletal framework of this zone. Then for this zone, you anticipate what? The first push, correction, second push, anticipate price coming back to this block to continue. And I told us this block is called the ICT or SMC order block. Supply and demand uses the same term as well, so that's it. So for the fair value gap here, it's just the fair value gap is just a set of candles that run concurrently in the same direction without any counter candle. Watch my videos on how to identify trend and you understand properly. And I mean, counter. I told us if you have more candles, more same color candles, the trend is valid. So when you have 3 to 4 impulsive candles going together, overlapping each other, there's a name we call it. So now let's say you have 3 bullish candles going together like this, like 3 thick candles going together. You have your candle, first candle, let's say candle A, second candle, B, the third candle. You see, yeah. Once you can identify 3 straight candles like this, 3 straight candles like this, then you pick candle A's high, extend it to the future. Okay, draw a line there. Sorry. Candle A's high, extend it to the future. Three candles C low, overlapping with B, extending to the future. You can see we have a gap created here. So this gap now is called a fair value gap. Fair value gap normally is an inefficiency price, like unhealthy price action. But on a norm, you're not supposed to see same color candles moving together so close with thick bodies. So anytime it happens, the institutions in the market. So once they create this kind of stuff, you already know, okay, big boys are here. Market will most likely come back into the zone to continue. So this one is for the bullish bias here. This is for the bullish markets. This is for the bullish markets. Then the bearish fair value gap is the reverse of this one. You see 4 sell candles going together. That's the first one. Second one. The third one. So now A candle will be here. A candle will be here. B candle will be here. C candle will be here. So this gap created on candle B, that's your candle A low. Your candle A low to candle C high. This zone now is what we call the fair value gap, FVG. Your FVG. Same thing here again. Your FVG, the fair value gap. So it's still a point of entry because you can anticipate price coming back into the zone to continue. I hardly use this thing. I hardly use it. I only trade on confirmation. Price will come here and continue. So let's go to the chart and check. Let's see if we can see some, just to identify them. Just to identify them. Right. You can see here now, you can see this, what's it called, this unhealthy price action, maybe caused by a news event or something. Then you can see candle one tick, candle two tick, candle three. Once you've seen the candles, this kind of candles that are so heavy in size, candle one here, bullish candle, candle two, bullish candle, third candle. You mark these candles high, that's the first criteria. Then you mark where the other candle touch the other one, that's it. That's heavy G here. So this is your favorite grab. And then you can see price came into it and continued the push. That's it. If you check here too, see first candle one, candle two, candle three. Although this one went to the extreme shot. You can see your fair value gap there. Exactly. You can see price came into the zone, rejected and continued. Okay, this one didn't feel okay, no three candles, no three candles. So this one is good. No three candles here. No three candles there. So that's that about LVG. I don't trade it much, so I don't trade it much. I don't trade it much. But there are the advanced ones that are not necessarily three candles. Let's see. If we see one candle here, candle two, candle, just three candles that are lacking. This one, the candles are the colors are not so together. If we see here now, candle one, yeah, candle two, yeah, candle three, the mark that they are created. And LVGs are basically used for continuations, not reversal per se. You see now, this gap created here, market came into it, rejected, came into rejected properly, and can see the sell. We can see the sell. Here again, if you notice here, price didn't come back to this extreme order block. And see, didn't touch it. Where did it move from? Possible fair value gap almost somewhere here. Good. I said the advanced ones will not give you the three candles completely, but if you train your eyes to see exactly, once you see a thick candle like this, giving you a breakup structure, any gap created is always valid. You can see that's it. This one now came back for the other block. And we see came back for the other block. You can see the push. Then here again, and we see one, two, three. Three thick candles, candle A, candle B, candle C. The more candles B details extend to the future. That's it. You can see market came into it, rejected, came into it, and this still happened. Here again, you can see how many candles. One, two, three, four. So you can let's work with the most recent three. Last one. If you check now, that's it now. Copy your candle A, candle B, candle C. Check. You can see the gap here. This was where they lapped. This was the other candles. I see the drop. Market came into the zone. That's it. I said if you have more same color candles, work with the most recent three. That's candle one, candle two, candle three. You mark these ones low, extend. Mark these ones high, extend. See how market came inside and dropped. So that's your ideal fair value gap. Let me check gold if I can. Oshimiri, ta. Um, and see gold. What did it do? Oshimiri, ta. Let's check. So what has gold been doing? the same thing. How do I mean? Let's go to the lower time. People can see something. Okay. You can notice here now. We had this last correction. The upside broke below our first breakup structure. Market corrected. Second break was supposed to trade from a market moved from somewhere here to that's that for that. Okay, I think I saw something about the bullish goods. What can you see here? Impulsive push, correction, impulse. What do I mean? The breakup structure was there. BOS2 at the extreme. Good. That was a BOS there. Your first correction is always your idea. Train your eyes to see. Then the last sell to buy candle that caused that first breakup structure as your order block. And you mark and extend to the future. That's it. See the push go did. So all these move now started from this zone. And see the buys happened. That's it. Then I think here too. Okay, it didn't come into the fair value gap. Why is it didn't come? Okay. Choose a look, but it's not so perfect. So I'll pass. According to my friends, I will pass. We check it too. We had this impulsive sell, a little correction, another impulse. So your first break, second break, inducement. The last buy to sell candle, the other block. And see, that's it. Market came into it, see the drop. So that's that. That's that. So your fair value gap is always big gaps created in the market. I told us about the advanced one. You can see here now we had this impulsive sell. Just look inside it, you see this gap. Train your eyes to see. That's your fair value gap. Sometimes you won't see three candles, but most of the time you can see these plenty sales, yeah. This gap created here, created here. Now see market came inside and dropped. So that's your ideal fair value gap. You won't see it perfect always. As my boss will say, once you see, you can't unsee. Here again, you can see impulsive push, first break of structure, correction, second break. You have your fair value gap here. You see I have your other block here. So good. Here again, you can see this impulsive push, candle one, candle two. Market came into the fair value gap and continued. Here again, the same thing. This push, this gap between this candle and this candle, that's your fair value gap here. Between here and here. And see price came into it, continued the push. So you won't get it perfect always. Here again, the same thing. Impulsive push. This candles high to this candles low. Market came back into the block and so basically the average ICT trader uses several stocks for entry. Yeah, for me, I use just the two, the order block and the fair value gap. Here again, you can see these impulsive sales. Impulsive sales. Most recent three candles mark the FVG. See, market came back into it and continued. So that's it, guys. So that's it for fair value gap. On the next video, I'll talk about the how to spot the high probability setups and how to validate them. So just anticipate. But I've laid the foundation already. What you need to see: impulsive buys, correction, impulse, correction, impulse. Once you have two valid breakup structures, your trend is valid already. So you have your first breakup structure, B1, second breakup structure, B2. Then your second breakup structure now, the leg where it came from, is your IDM, IDM, IDM. Then you look at the extreme for either your fair value gap or your order block. Then you anticipate price comes back to this zone to continue. You flip it for the sell bias. Okay. All right, guys. So that will be the last in this video. So go through the videos, like watch them over and over again. Digest what I'm teaching because I'm trying to use the simplest terms, simplest possible terms for us to learn and be on the same page. And always drop your comments, refer your friends to this channel and subscribe. Alright guys, stay put to the next video. Safe.